All right. James Rickards says if you don't have velocity, you don't have an economy, period. Now, this comes from a recent interview with Trigonometry, um, which is a really great show on YouTube. They also have a podcast where they get a lot of contrarian thinkers on to speak about the economy, politics, so on and so forth. So they brought on Jim Rickards. They also brought on Pippa Malmgren, who I also really like her thinking in with economics. Um, and they asked him about inflation. Pippa says that she sees inflation coming. Jim Rickards actually said that he doesn't see inflation coming yet, but he does see inflation coming in about a year or so. But right now, in the immediate future, he sees deflation. And the reason why he says this is because of something um, called velocity and velocity's impact on inflation. So here's the thing. Again, his quote was, if you don't have velocity, you don't have an economy, period. So, what is velocity? Velocity is pretty much how often you take your currency and it gets used up, and how often it gets used up. So, say for example, if you have a dollar and you give the dollar to a cab driver, the cab driver gives it to his grocery store clerk, and the grocery store clerk then gives it to another cab to get back home, that dollar was used three times. So that's one times three. That means you have a velocity of three because one times three equals three. Now, if you have $1 million and you never use that $1 million, it's just sitting in your account and it never gets exchanged with anybody. So you have a velocity. So it basically gets moved around zero times. So you have $1 million times zero. You now have a velocity of zero. So imagine if this happens with everyone in the economy at the same time, in the same place. Well, you don't really have to imagine because guess what? It's happening right now. Right now, we have two sides of the economy being stretched really thin. We have the demand side and we have the supply side. And Jim Rickards in this interview was talking about how we got all this liquidity just being pumped in, but definitely don't call it a stimulus check that you've received in your account. If you got 1,200, if you got a little bit less, he says don't call it a stimulus check. The reason why is because that money that you likely have, if you don't have if you have enough money right now to last you, is probably going to be sitting in a savings account. Now, if it's sitting in a savings account, how is that really stimulating the economy? So, what Jim is saying is that people aren't really holding on to their money, or the people aren't really spending their money at rates that they used to be spending to really impact the inflation rate. So in previous videos, I have showed you that the inflation rate, has gone up, has gone down in relative terms to recent years. But if you take a look at past years, you take a look at the 80s, you take a look at, even in the 2000s, inflation rate was way higher, 6%. In the 80s, I believe it got up to I think it got up to past 10%. Correct me if I'm wrong, but it was in double digit territory. So recently we've been struggling to stay at 2%. So the reason for that is because the inflation rate has generally been trending down, and I'm going to give you some data right now to back this up. So this data actually comes from one of our favorite websites. Obviously, it comes from the Fred, St. Louis Fed Economic Research, and this comes from and this chart is actually the velocity of the M1 money stock. Now I'm going to scroll down here and I'm going to give you a brief blurb about what we're about to read. Okay, the velocity of money is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time period. Now I'm going to jump down here. Consider the M1, the narrowest component. M1 is the money supply of currency in circulation, notes and coins, traveler's checks, non-bank issuers, demand deposits, and checkable deposits. A decreasing velocity of M1 might indicate fewer short-term consumption transactions are taking place. We can think of shorter-term transactions as consumption we might make on an everyday basis. So think of your everyday transactions that you might make, and let's see how the velocity has played out since 1959. So let's take a look. Velocity was basically pretty low around 1959. Probably one of the reasons for that is that that generation at the time, the silent generation, they were savers. They weren't really the type to really be going out there and just spending willy-nilly, because they got essentially punched in the face by the Great Depression. But as time goes on, people become a little bit more spendier. With more generations coming out, baby boom generation, etc., da 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 da, they get older and they start spending more. They get further and further away from the generation that was impacted by the Great Depression. So here we have a high point of velocity in 1980. Now, this probably should raise a red flag for you, because you probably realize that, oh, that's around the time when inflation was also pretty high. Now, again, this is the money that's already in circulation, and it's the day-to-day money that you're already spending. So, it isn't really that much of a tell on as far as like what will really impact inflation, but it still is a component. Still, things are trending upward. And then things start to slowly trend downward. But again, when it comes to money that's already in circulation and it comes to the day-to-day things that people spend on, it's probably not going to change that much, except in particular time periods, such as, boom, when people are feeling very wealthy, they'll be like, all right, I'll spend a little bit more. So obviously, before the Great Recession, the M1 money supply velocity was being spent up like hotcakes. That velocity was being churned around so much. And then as soon as the Great Recession hits, look at that rate of decrease right here between 2007 or 2008 and 2009. It's just this crazy drop. And then ever since 2008, we hit an inflection point. Basically in 2008, we hit an inflection point, and ever since then, the psychology of the everyday American changed. And it changed drastically. Look at the rate at which we have changed our behavior within 10, 12 years versus the previous 12 years. So let's go back to 96. We slowly were changing our behavior, and we drastically changed our behavior down here. So this graph ends at Q4 of 2019. I can only imagine what this looks like in 2020 for Q1. Why do I say that? Because in this period, we hit 5.501 in Q4. But when was the last time we hit 5.501 in in the span of history? It wasn't down here in the 90s and 94 in this little trough here. It wasn't down here in 1987. It was all the way back here, 5.5, let's just say right around here in 1973 was the last time we as a country were at this rate of velocity for the M1 money supply. So the day-to-day things that we're spending our day-to-day currency as if it's 1973. Now, I'm going to take you over to the granddaddy of the charts for velocity, and that's the M2 money stock. Now, your eyes, if you are a pretty quick read on things, are probably looking at the beginning of this chart in 1959, and you're probably looking at where we are right now, or right before where we were right now in 2019. And we basically in this period of time have never been this low. Even during the period of time when people were saving money more so in America, they were not this thrifty as we are now. So what the hell is the M2 money supply about? So let's read this right here. I'm gonna bring this over. Okay. The broader M2 component includes M1 in addition to saving deposits, certificates of deposit less than $100,000, and money market deposits for individuals. Comparing the velocities of M1 and M2 provides some insight into how quickly the economy is spending and how quickly it is saving. We are saving money at rates that we haven't seen in decades. I can honestly say that in decades. Look at this. Generally, we've been hovering around this 1.7 rate for some time, right below 2. And then we started spending a lot more of our money, obviously in the great, or I'm sorry, not in the Great Recession, around the dot-com bubble pops. And then right around 2007, 2008, we had the Great Recession. And then again, huge decline within a short period of time. Huge decline. And ever since then, we've just dropped. Now, in 1959, we were at 1.773. And in that period, it hit as low as 1.653. Let's see where we were after the Great Recession. So 1.6 was basically in 2011. Now in 2011, you may remember, oh yeah, didn't gold shoot up? Gold shot up around that time. And people were holding on to money. And ever since then, you can see that we've been slowing down just incredibly. Now, again, this chart ends on Q4 of 2019 at 1.425. I am curious to see what this chart looks like in Q1 of 2020. If we hadn't seen rates of velocity this low, basically during this period of time that the Fred economic research is giving us, then what could it possibly look like now? So if you take a look at, if you think about this, the inflation rate is probably not that strong in absolute terms. So what's going to happen in the near future? Obviously, velocity is probably going to continue to sink. And again, velocity is a big part in keeping the inflation rate up because people aren't, churning money around. Now let's take a look at the U.S. inflation rates. Again, in 2011, we hit a peak and then it started to go down. Now remember, the CPI, or as Mike Maloney likes to call it, the CPI, is highly manipulated. But even though it is manipulated, they still have not manipulated it to the point where it is not going down. I would like to call this a nominal inflation rate. That's what I would like to call it. But because it is trending downward, or it trends in the way generally that the real inflation rate is likely trending, not at the magnitude of the real inflation rate, but in its pattern, I feel like it's a good read on where things are slightly going, even in nominal terms. So the Fed had to raise the interest rate nominally to get this guy kicked up here because it was going low. And remember, the Fed needs to keep the interest rate up. And when it doesn't do that, uh, essentially, we have a problem with the economy. When this happens, we're heading towards deflationary territory. And, Jim Rickards also often says that a depression basically is when, and I'm going to butcher this, but basically says when there's no potential for growth in sight. Now, even during these very prosperous times for the economy, um, as far as the inflation rate is concerned and having to raise the interest rates just to keep it up around here, you know, to me, this is a red flag. You know, Generally, this is the nominal inflation rate. I can guarantee you the real inflation rate um, was probably in the negative territory, which means we probably had deflation, or we were closer to deflation, and to prop this guy up. And it looks like we can't keep it up. We can't keep it going again. We're at zero. Um, and remember, around this time, we were around zero for the nominal interest rate. So now we're at zero here, and the inflation rate is going low. Expect it to go lower. We will have some deflationary activity in the near term. When things start to look positive, expect hyperinflation. This is why people like Mike Maloney, this is why people like Jim Rickards are saying that in the short term, we will have deflationary activity, but expect after things start to get a little bit better, we will have inflation, hyperinflation happening in this country once again. Because we can't keep up this trajectory. We're gonna need to have a reset, unfortunately. And once that reset hits, it's gonna be hitting like gangbusters. Interest rates are gonna go through the roof. So when that happens, be prepared. You know what to do when it comes to dealing with inflation rates. Get in while the price is low if you are interested in gold. And when I say low, I'm talking relative to what we are probably going to see in the future. Um, so for me, I'm waiting on the perfect time to get into gold. Um, at the moment, I'm really eyeing silver, just because in relative terms, it is one of the most undervalued assets at the moment. But I really want to get some more ounces of gold. Let me know what you guys are planning on doing in the comments section below. Thanks again. This is Black Bullion. Please subscribe. Have a good day.